Hi guys, good morning. It's a Tuesday morning. I'm Reema Tendulkar. With me is Sonal Boothra. The picture across the benchmark indices is flat. The mid-cap index is a little bit of green. Banks have a little bit of red going for themselves. But again, when you look at the Asian market picture where all of them are down 1.5%, 2%, flat is good.
Oh, yes. And flat is coming after the cuts that we've been seeing, right?
Yeah.
But, what's an outlier today is the mid-cap index. It's up around 0.2%. And that is because of a lot of moving parts on the back of numbers. Earnings, they are still coming in. We're towards the fag end of the earnings season, of course. But there are big moves that we're seeing on the back of earnings. For instance, we have Jubilant FoodWorks, which is up 8%. UPL on the back of positive management commentary is up around 5.5%. We have EPL, which is up around 4.5%. So it's all about earnings and individual stock moves. So the advanced decline ratio, 1,200 stocks on the advancing side for every 1,000 stocks on the declining side as well. Pharma space is doing well. The small cap index is up around 0.5%. So all in all, yes, we are flat after seeing a surge at the start of the trading hour. We've come up from the highs, but again, as Reema pointed out, after looking at the Asian markets, this is not something that the Indian markets would complain about as well. But we do have a lot of management conversations which are lined up on the show today. So let's get started with that in just a bit. But before that, let's talk about TVS in terms of the numbers that they gave this time around. The stock that'll come up for you on the screen, and we'll just see how that's performing right now. But overall, if we look at the numbers, it was a slower revenue growth. Margins had contracted. Profits were led higher by other income and lower finance costs as well. So overall, revenues were up around 11%. EBITDA was down 8.5%. Margins contracted to 6.7% versus 8.2%. And it was a profit versus a loss last year. So that is the first corporate on our radar. Let's get in the quarter gone by and the outlook for FY25. We have Mr. Ravi Vishwanathan, the Managing Director, and Mr. Ravi Prakash, Global CFO of the company, joining in now. Gentlemen, good morning. Thank you so much for joining in today. Well, it has been on the weakish side if we talk about the margins this time around. Can you explain what went wrong with the margins and what is the outlook on overall growth on revenues, profits and margins for FY25?
Yeah, thank you. And, we've shown a very healthy growth in revenue, about 11% year on year, and we continue on our growth momentum. Margins have declined a bit, but if you look at it from an integrated supply chain solutions, that has been our growth engine, and that's something which we've been talking to you in the past, and that has grown very significantly, and we have 11% EBITDA on the ISCS segment. The network solution segment has been a bit volatile, and we're very proud of the fact that we're growing revenues in spite of weak macros. But I would say that network solution segment is still work in progress. The good news is that one of the segments there, the integrated final mile, we had reported some challenges earlier, and we have put that behind us, and we expect to have run rate profitability coming in from the end of this fiscal year, that is Q4 FY25. So overall, outlook is very positive. Revenue momentum is great. We are winning significantly large deals. We've spoken about it in the past. We had won a very large deal with a UK customer earlier last year, and we've reported a similar or a larger contract signing in the last quarter with a North American customer. So we are very positive and bullish about the outlook as we look at the half-year performance of the company.
Gentlemen, hi, Reema here. Ravi, just explain the decline in margins seen on network solutions. I understand it's work in progress, but are there any factors which led to the margin decline? And since one of the segments of this will turn profitable or the outlook is improving, do you have any exit margins in mind for the network solutions business?
Yes. So Reema, in the network segment, there are three factors which actually impacted this quarter. Because of the impact of the Red Sea, what is happening is the ships have, in the freight forwarding side of the business, we are having to incur significant costs for a number of our customers, which is actually simply an add-on to revenue with no incremental margin. The impact of that is almost, in revenue terms, almost 80 crores. That is actually depressing the margin because it's kind of revenue without any margin. The second part is, like Ravi Vishwanathan talked about, our business, the last mile business, integrated final mile business. We had signaled that it was a work in progress in terms of profitability. The progress is good, and we expect that the coming quarters, the numbers will improve. And therefore, if I look at Q3 and Q4, we would be comfortable if we were to exit Q3 at closer to the margins that existed maybe a couple of quarters ago, and then probably trend towards our target margins of about 7% over the next 3 to 4 quarters.
Okay, 7% margins over the next 3 to 4 quarters. This is for the network solutions business.
Yes.
Okay. You spoke about a large industrial customer you had in North America. You've been winning new contracts as well. And there is one 7-year strategic contract with a UK governmental agency. Can you give us a sense of what is the order pipeline looking like in terms of these contracts? What is the execution timeline as well? And what would the expected margins in the newer contracts be? Mr. Vishwanathan, if you can take this.
Sure. Yes, we have signed probably the largest contract in the history of the company. It's over 22 plus crores as the total contract value. It's a multi-year engagement with an industrial segment customer. Hopefully, we'll be able to get to a place where we can share the name of the customer as we progress, but we still are under very strict confidentiality. But having said that, we continue to look at large deals as a vehicle of growth. We have significant number of large deals that we are participating in. The number of large deals that we participated in 3 years ago versus now in the US has gone up by about 2.5 times and about 3.5 times in the UK. So it clearly positions us as a large contract player, which we were not 3 years ago. And it augurs very well for our growth. From a profitability perspective, like Ravi Prakash mentioned, we look at growing our margins. Our EBITDA numbers, we had indicated at a company level, we want to grow it to double-digit EBITDA, and that's going to come on the back of these large contracts. So we expect the larger contracts to be at a differential to the current EBITDA margin that the ISCS segment has, and ISCS already is performing at a double-digit EBITDA number. This quarter, our EBITDA margin was about 11%. So this large deal is in the ISCS segment, and we expect the margins to be better than what our average margins.
Yes, how much better would those margins be? 200 basis points, 300 basis points, any number there?
Maybe, I think let's not maybe put a number on that. Definitely better than what we are having in our average margins for the ISCS segment. On a lighter note, let the contract start and we start delivering numbers and let the numbers come through the results.
So Ravi, this aspiration of double-digit margins, when will you be able to achieve it? And you also had given a guidance of 4% PBT margins and 16.5% ROCE by FY27. So this double-digit margins is by FY27, I presume?
Yes, I think that goal still stays. Look, the ISCS segment has already hit double-digit EBITDA margin. Network segment, I already reiterated our target is to get to around 7% at a start. And then once we do that, and if we continue the revenue growth like we have right now, and we are holding a very tight rein on our overhead, operating leverage will come through. And we do want to stick to the 4% PBT margin by 27. So that sticks.
All right. Okay. Thank you, Mr. Ravi Prakash and Mr. Vishwanathan, for joining in today and giving us the details of the quarter gone by and, most importantly, the outlook going forward. That's the word coming in from TVS Supply Chain Solutions. The stock is up by 3% on the back of the numbers and management commentary. Time for a short break now. On the other side, we'll get you the management of Bank of India to discuss the bank's second quarter performance. Stay tuned.
Welcome back. RateGain is a stock in focus. The stock is tanked 9%. Yesterday, it came out with their numbers during market hours, and the stock was trading okay because it was about a 21% kind of a top-line growth. There was margin expansion, and the stock did okay. But today, you are seeing pressure on the stock because the company, in the conference call yesterday, has lowered the top-line guidance. The earlier guidance was 20% for the full year. They're now talking about a 15% guidance. There are 4 key reasons given for that. One, they've lost one of their large clients, which is a hotel company, on account of M&A. That company went through M&A, so that they've lost the work related to that. Secondly, weak order booking due to delayed decisions by clients. Third, normalization of travel demand in the US. And fourth, they're also seeing pricing pressure in some of the large contracts. So these are the 4 reasons cited by the company for the top-line guidance cut. That said, they continue to expect margin expansion. Last quarter, the company had upped the margin expansion growth guidance to 150 to 200 basis points. They're holding on to that. And analysts believe the company is on track to achieve it because in the first half of the year, they've done about a 180 basis points margin expansion. Kotak today has downgraded the stock to a reduce. Their target price is at 800 rupees. They believe the stock is trading at full valuations. Therefore, they see limited upside from current levels. And that's the reason why they've turned cautious.
Okay, so big cut on the stock.
Big cut,
yeah, exactly. So it's a 9% cut. And it was one of those big listings, right, during COVID, which saw stellar
It was
return.
a darling of investors over the last 1 year. It did very well
Play on
because it was a
travel.
play on travel.
Correct.
And it's, their platform play. You've got tech in it and you've got travel. It was just the right combination.
And travel was not just stopping at that point in time. It just surged.
But
and
now,
how-
as I said, normalization of travel demand.
Exactly. But before we go across to our next management, let's quickly take a look at what the markets are doing. Because as I said, we are towards the fag end of the earnings season and a lot of stocks reacting to their earnings. We have DEE Development, that is another recent listing, and that stock is up 17% on the back of numbers. Decent numbers, and that's what the street seems to like as well. The other one is Orient Technologies. That stock is also up around 11%, so watch out for that one. We also have Firstsource. Of course, numbers were reported a while back, but today it's making a comeback. The stock is up around 5%. So these are some of the broader market movers that we wanted to highlight. But Bank of India, that's the stock on our radar, posted a mixed set of quarter-2 earnings. The bank's credit deposit ratio came in at a 38-quarter high, and net interest margins declined. To discuss the quarter gone by and the outlook going forward, we are joined by Mr. Rajneesh Karnatak, who's the MD and CEO of Bank of India. Mr. Karnatak, good morning. Thank you so much for joining in. Well, your credit deposit ratio is at a 38-quarter low, but NIMS came in at a 9-quarter low. What happened here, and how did you lose out on net interest margins this time around?
Yeah, thank you so much. As regards our CD ratio is concerned, we are at a global CD ratio of around 80%. But if you see our domestic CD ratio, it is at around healthy number of 77%. So just to give a flavor of the book, 15% of our total global business is the international business. So the NIMs in the international business are much finer than the domestic NIMs. So domestic NIM is at a healthy number of 3.14 and the global NIM at 2.80%. Though it has come down, but we are sure that this whatever the NIM we have shown at 2.80% has now bottomed out for us for Bank of India, and it will be a better NIM in the ensuing quarter of Q3 and Q4. As regards the overall the income is concerned, that also is much better, and non-interest income also we have improved, because of which the ROA has also improved for the bank.
So what is the NIM guidance? You said it has bottomed out now and it will only improve from here on. What can you guide for in terms of net interest margins?
So on a financial year 25, we are saying that we'll be at around 2.90%. Because this is bottomed out and the domestic NIM is healthy at 3.14%, and with the busy season coming, we'll be able to improve our net interest incomes and therefore the net interest margins in Q2 and Q3 and Q4.
Okay, so NIMs currently at 2.8 have bottomed out, and by Q4 FY25, you should inch it up to 2.9%. So your slippages have increased on a quarter-on-quarter basis. Your slippage ratio is now at a 5-quarter high. Can you give us some guidance on slippages going forward, and what led to the increase? Where is it that we're seeing stress?
Yeah, as regards the slippage is concerned, in this quarter we have touched the fresh slippage of nearly 2,500 crore, which was in the Q1 at only 1,900 crores. So in this quarter there is one lumpy slippage in the corporate book which has happened. because of which this amount has gone up to 2,500 crores. Had this amount not been there, slippage in this quarter would not have been there. The slippage, overall slippage would have been near to around 1,500 crores only. So as regards the credit cost and the slippage ratio, which has increased in this quarter, had this one particular account not been there for the bank, both the credit cost and slippage ratio would have been much better than the Q1 numbers. However, this is an aberration for this quarter only, and going forward, we do not see any further stress coming out and NPA coming out of the corporate book in the Q3 or Q4 numbers.
Okay, if you could tell us which was this big account that led to that increase in slippages in the quarter, Mr. Karnatak, and what is the recovery that you're expecting in NPAs this year itself, since you're saying that you do not expect any more slippages to come by the corporate book and it will be stable going forward?
Yeah, this one particular account is one PSU which has slipped for us, and we are in talk with the management, and some resolution process is on for that. Maybe some restructuring or something will happen with that, and we will definitely foresee not much of a hit in that account, and some resolution will be coming out, and we are in talks with the management. As regards the overall slippage is concerned, last year we had an overall slippage of around 7,900 crores. We are very confident that in spite of this one single account slippage, our overall slippage in the system for FY25 would be around 7,500 crores, and the slippage ratio should be around 1.40%.
Okay, so in the first half, you've done about 4,000 crore of slippages. So for the full year, you should be closer to 7,000 crore, right? In terms of slippage ratio? Okay, sorry. Also, what about the asset quality? Gross NPAs from 4.4%, where do they trend, sir?
So the gross NPA now is at 27,000 crores on the absolute number. On the percentage number, it is at 4.41%, and we have reduced our gross NPA by 163 basis points on a YOY basis. On net NPA also, we are at around 5,700 crores, which is around 0.94%. So as the guidance is concerned, our gross NPA should be shade below 4% in FY25, and net NPA should be at around 0.90% by FY25.
Okay, so gross NPA will be below 4% in FY25. Already in this quarter, it's around best in 10 years or more, the asset quality for the bank. But Mr. Karnatak, since you're saying things are looking good going forward, what is the reason that you've stopped giving restructured book details? What was it like this time around?
So it is the same number. In fact, it was repetitive every time. So there is not much change in that number. Whatever the number was there for the last quarter, it remains the same number. There is no change in that. Let me clarify.
Okay. All right. So let's talk about the other aspects of the business as well. This time around, deposit growth came down slightly. It was, in fact, it was not as strong. Quarter on quarter, it improved by 1.4%. YY, it improved by 10%. How do you see deposits and loan growth going ahead?
So as regards our business growth is concerned, on the global side, if you see, our global business has grown by nearly 12%. Deposit in the global side, it has grown by 10%, and the credit has grown in the global business side by around 14%. However, if you see the domestic book, the overall growth has been around 13%. Credit growth in the domestic side has been 15%, and the deposit growth in the domestic side has been around 12%. And the overall absolute numbers, if you see, we have grown the book YOY basis by 1,50,000 crores. Within which the deposit has grown at around 71,000 crores and advances have grown by 78,000 crores. So there has been very strong demand as far as the credit is concerned. Deposits, on a conscious call, we have not taken the bulk deposits, because we were comfortable with the supply side which was there for the enabling of the credit growth. So we have taken 5,000 crore of this year infrastructure bond. Another 5,000 crores we will be raising in the Q2. In Q1 in this Q2 again we raised Tier 2 bonds of 2,500 crores. Another 2,500 crores of Tier 1 bonds will be raising in H2 of this financial year. Apart from that, we did some refinance, and also we have excess SLR with us, nearly 40,000 crores. Against that also we did some borrowing. So whatever the credit growth is there for future, it will be well supported with the deposit growth and also through the other resources which are available with us. To give you further perspective, let me say that our credit pipeline is more than 70,000 crores, which is more than 10% of our global credit book, and we are well paced for the Q3 and Q4 for the guidance numbers which we have given for a credit growth of around 13 to 14% and a deposit growth of around 12 to 13% for FY25.
Okay. All right, Mr. Karnatak, thank you so much for joining in today and giving us all those details. So that's the word coming in from Bank of India. They say that net interest margins that have bottomed out and they expect gross NPA to be sub 4% in FY25. With that, let's move on. As CNBC-TV18 celebrates 25 years of excellence, we invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on November 14, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only and only on CNBC-TV18. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Well, EPL, the stock is up around 4%. Just wanted to highlight it has been a good set. There's been a margin expansion of around 150 basis points and 9th consecutive quarter of margin expansion. So the stock is higher by 5% and debt reduction is also what the street seems to like. But Britannia continues to be in focus. It is on the back of management commentary in its conference call. Mangalam, tell us the details. What did the commentary look like? The stock is at the day's low.
The stock is at the day's low, a 5% downtick yesterday and followed up another 5%. And if you look at the intraday chart, you would see that most of the decline happened in the last 1 hour itself or so, ever since the conference call was underway. We were hearing listening into what the management had to say out there, and the commentary was far from positive. In fact, they have initiated focused pricing actions in specific channels to counter inflation. They are closely monitoring commodity situation and assessing its impact, remaining vigilant of what competition is also doing, and at the same time they will focus on driving market share while sustaining profits. The most important part, however, is that there may be some impact on volumes in the short term. Remember, the last 3 quarters, volumes of the company have been between 6 to 8%. So over the next few quarters, with commodity inflation, maybe the company would have to reduce grammage, and at the same time we're going into a high base zone as well. So that could be a concern on the volumes in the very near future, because the demand scenario, as the management says, and all the other companies have been saying, is still not as robust as it has been in the past. They will try to balance both volume and price going forward. That means that the scope for further margin expansion from current levels may also be reduced. So those are a couple of factors that we'll be watching out for very closely for Britannia. After a 5% decline yesterday, the stock's down 5% now as well.
Okay, it's a sharp cut. Thank you very much for that. We'll come back and discuss market fundamentals. Daniel Morris of BNP Paribas Asset Management joins in next.
Welcome back. You're still tuned into Trading Hour. Let's get in a conversation about the markets, global equities, and a lot more. Daniel Morris from BNP Paribas Asset Management is joining us now to discuss market fundamentals and a lot more. He's flown in from London for this conversation as well. Daniel, pleasure to have you in the studios with us. And there's so much that has happened in the global economy. We've just been talking about it in the last 1 week. The big change in the government in the US, a lot of geopolitical activity as well. How are you looking at the global markets right now? What are some of your top markets that you're looking at?
Well, if you start with what happened, say, under the first Trump administration, you did see that equities overall did quite well, and U.S. equities in particular. So as a starting point, our assumption is, at least at the beginning, we'll see how things go in the future, that it is going to be, certainly relative to the expectations we had prior to the election, a good environment for U.S. equities. And so we've actually increased the overweight that we had to U.S. equities.
Okay, so US equities is an overweight.
Yeah.
What else as an investment class, equity or otherwise, are you bullish on and why?
Just generally still positive on gold. We'd been quite overweight before, so we've reduced the overweight, but still a lot of these structural factors supporting gold prices. So the other overweight that's notable besides equities is gold.
Any other equity market in the world that you're bullish on?
Well, no, but it's partly a mathematical function. If you look at the size of U.S. equities or the U.S. market in the MSCI index, it's either from 60 to 70% if you're looking either at the world index or the ACWI index. So kind of by definition, if you're overweight U.S., there's not a lot else that you can overweight that's going to have an impact on that.
Okay, so U.S. continues to be the big overweight for you right now. But I have to ask you, since we are in India, talking about Indian markets, we've spoken about this big stellar rally, but FIIs have been pulling out in the last couple of months. What's your call now? Do you think India will maybe see consolidation, or will you look at India at any point in time? What are the factors you're watching out for in terms of taking that bet on the Indian markets?
I think, like a lot of people, it is a concern primarily around valuations. And I think it's notable if you look at the performance of the market, which we appreciate over the last couple of years has been quite good. But then you look at the underlying earnings trend. So earnings have gone up. Expectations are positive for next year, but it's just whether they've gone up quite as much as the price has. So hence that increase in the valuations. So I think what we would like to see is not only perhaps somewhat lower valuations, and of course that can come about one of two ways. You could have a sell-off or a correction to some degree, or if you see an acceleration in earnings, that also would bring down the PE. So I think that's probably one of the key triggers that we would be looking at before making an allocation.
Okay. So do you think one of the other risks could be any tariff activity by Donald Trump? Because that's also something that every market watcher is talking about as well, not only in India, maybe Chinese markets, maybe other Asian markets.
Certainly it's a risk. I think at this point, it's just frankly quite hard to know. There's a lot of things that politicians say, as we know, during elections. They don't necessarily do everything they say, and that's probably true in most places. So really it is a bit of a wait and see at this point. You know, what actually transpires, what are the proposals, what is Trump trying to achieve, and then we'll evaluate what we think the impact is going to be.
Is there a risk to global growth? In the event that a tariff war, trade wars take place? You make America great, but it comes at the expense of something.
Well, without question, it's a risk. I think we're all hopeful that it doesn't go quite that far.
Should you position your portfolfolio for that?
We're certainly not positioned that way yet. I think it's
So your base case doesn't assume any tariffs? 10% or 50, 60%?
I don't think we have a base case in terms of how much tariffs might increase. Again, it's just stuff that's been said during a campaign. We're just now beginning to nominate people that might be in the cabinet, you know, head of trade and so on. So we really do need to wait and get a bit more information before having any kind of scenarios.
You know, Daniel, you're at the heart of what happens in the Europe, right? So there's a lot of activity there as well. Are you liking the fixed income space there or the equity markets there? And what makes you bullish on either of the spaces that you like?
Sure. You mentioned fixed income, and I think that really is the area we're probably going to be a bit more optimistic than in equities, and particularly if you look at it on a relative basis versus treasuries, because if you think about the U.S. Treasury market, you anticipate perhaps higher inflation than you had before, higher growth, and therefore higher policy rates, Fed funds rate than you anticipated before. All of that suggests there's at least the potential that treasury yields go up. In contrast, you look at Europe, growth certainly on a relative basis rather slower, arguably disappointing. Political uncertainty in Germany and in France, so all of this would argue for lower yield. So from a fixing point of view, we're overweight the Eurozone government debt versus the U.S.
Are there any particular sectors you think would outperform, and that is something which would have an impact on global economy as well? In the U.S. markets, is it the artificial intelligence space that you're looking at? There's so much happening in semiconductors in India. Of course, I know other countries have taken a lead there already, but is there any specific theme that you're looking at?
Absolutely. I mean, within our U.S. Overweight, a part of that is specifically the NASDAQ. So we do see that opportunity. And I would argue a bit more broadly than just AI, certainly more broadly than the Mag 7. I think, you know, our objective is to be exposed to the broad set of the opportunities instead of trying to know or to time when the particular stock is going to be winner or loser. We think there's, you know, significant potential for earnings within the NASDAQ. And I think importantly, and this is perhaps something not a lot of people appreciate, valuations actually aren't that high. They're above average, but so is earnings growth. So that warrants a premium, we think, relative to other parts of the market.
So you don't have coverage on India per se, right?
No.
It doesn't make it to your portfolio allocation as of now. So what brings you to India? What are the conversations that you're having? Who are you out there to meet? And is this a step towards you perhaps considering, investing in India?
Well, so here meeting with our clients, that time of year, coincidentally after the U.S. election, but really it was more a 2025 perspective, what we anticipate for next year. So sharing our view from London, if you will, and from Paris, how we anticipate, particularly U.S. economic growth. We talked a lot, of course, before the election about a soft landing scenario, slower growth, lower inflation.
And the soft landing is now out of the window?
Well, it's maybe a bit less likely, the timing is, I think, open to question, and we're starting to envision a no landing scenario, i.e. growth really doesn't slow and inflation doesn't fall. So trying to anticipate what that might mean for different asset classes.
Okay, and one quick word on the number of rate cuts we see from now till the end of next calendar year?
Well, the market's still looking for 3 to 4, perhaps.
Yeah, but we're in a no-landing scenario, right?
Yeah. So I think, if anything, it's safe to say probably fewer than we thought before the election.
Okay, all right. Take that point, Daniel. Such a pleasure speaking with you today.
Likewise.
It is that time of the year, so getting into the holiday season as well. So thank you so much for coming down and having this conversation with us. Hope to be speaking to you very soon again.
Likewise.
Okay, all right. With that, we'll do one thing. We'll slip into a short break. On the other side, we'll be joined by Amit Ramani, who's the MD and Chairman at Office Space Solutions, to discuss the company's quarter gone by. Stay tuned for that.
Still very unchanged on the benchmark indices. Absolutely, 2 points down on the Nifty. Sensex up close to about 12 points. Numbers coming in from Uno Minda. It's a 9% jump in the profit. The stock is currently up close to about 4%. The revenue surge is more. Revenues are up 17%. But let's get to our special segment, FinStreet. Abhishek is now joining in. He's focusing on the auto financiers, the trouble that we've seen with growth and the pain in the sector.
Well, after the microfinance sector, is auto financing facing issues with respect to growth and pain in the books? Let's see. Now, auto financiers have been outliers in Q2 FY25 amongst the NBFCs with respect to AUM growth. But the pain in their books is rising. In Q2 FY24, the disbursements growth was in the range of 17% to as high as 47% on a year-on-year basis. And in Q2 FY25, the disbursements growth rate is in the range of minus 1.2% to 15.5% on a year-on-year basis. In fact, Sundaram Finance saw a decline in their disbursements growth both YOY and quarter-on-quarter as well. Now, AUM growth had been healthy in Q2 FY25, both YOY and quarter-on-quarter, but it was way lower than what they had seen in Q2 FY24, both YOY and quarter-on-quarter. So, for comparative purpose, Q2 FY24 had seen AUM growth range in the range of 19% to 46% YOY and about 5 to 9% on a sequential basis. But in Q2 FY25, the AUM growth rate has dipped down to 18.5% to 33% YOY and about 4 to 6% on a sequential basis. Most of this growth has come in from increase in loan tenures. Now, most of the lenders enjoyed quarter-on-quarter net interest margin improvement in Q2 FY24. Only M&M Finance saw a decline in the net interest margin in Q2 FY24. But this trend has reversed in Q2 FY25 as most of the lenders have seen decline in the net interest margin on a sequential basis. Now, asset quality in Q2 FY24 had improved quarter-on-quarter for all the lenders. So, in Q2 FY25, ex-Shriram Finance, all these lenders have actually seen deterioration in their asset quality, which could be a signal of the times to come in the coming quarters. Now, NPA cycle in the lending sector starts with microfinance loans, then moves on to unsecured loans like credit cards, personal loan, etc. After that, it moves to car loans, auto loans, vehicle loans. Post that, it moves to the SME sector. After that, small and mid corporates, then large corporates, and worst case scenario, we have the home loans. Typically, home loans NPS does not happen very frequently, but this is the worst case scenario. Now, higher capitalization gives the ability to absorb any negative shocks coming in from deterioration in asset quality, if any. Most of the lenders that you see on your screen are strongly capitalized, anywhere between 16% to 20%. Now, the regulatory requirement is about 15%, and MMFSL is the closest one over here at 16.7%. Let's take a look at the valuation picture. These lenders are trading on a 1-year forward basis at a price to book value in the range of 1.5 times to as high as 5 times. Mahindra & Mahindra Finance is the only lender amongst the peers who is trading at valuations below its 10-year historical average on a 1-year forward basis. Now, Sundaram Finance is trading at higher valuation than its 10-year forward basis if you take a look at the historical average on a 1-year forward basis. So, comparatively, M&M Finance has the lowest valuation amongst peers, while Sundaram Finance has the highest valuation amongst the peers.
Okay, all right. That's our special segment, Fin Street. But it's time for a break now. Management of Office Space Solutions will be joining us on the other side to discuss their Q2 earnings. Stay tuned for that. Welcome back. You're still tuned into Trading Hour. Office Space Solutions posted a strong set of numbers with revenues up 40%, EBITDA up 66% YY in Q2 FY25. To discuss the numbers, we have with us Mr. Amit Ramani, who's the MD and Chairman at the company, joining in now. Amit, good morning. Thank you so much for joining in. Well, it's been a strong set, no doubt about it. Margins have improved substantially. Can you give us a sense of what led to the sharp margin expansion? Was it just driven by higher volumes, or was there better pricing and cost optimization as well?
So I think all of the above. Clearly, I think our occupancy has gone up by a couple of percentage points. Instead of 71%, which we reported in the last quarter, we are sitting at 73%. In general, the commercial real estate market has had very strong demand. And as a result, the base market rentals have improved. And as a result, our seat pricing realization has improved, and which has obviously impacted the margin. And yes, there is operating efficiency, operating leverage that has come into play that is driving these margins up. So clearly, I think all of the above have made a difference and has resulted in a great quarter result for us.
So it's a 40% revenue growth for you this time around. How much was it led by volumes, seat additions that is, and how much was it because of pricing? In the vintage portfolio, in the new portfolio, how much of a price escalation are you seeing?
So typically, the guidance that we have is typically year on year, it increases by about 5%. We are seeing a bit higher year on year increase because of the base rentals being higher. In terms of the seat addition, we this year till date have added this quarter about 10,000 seats. So we currently have 110,000 seats that are operational across 180 centers and 18 cities today. Including the under fit-out centers, we have another 20,000 seats. And if I include the letter of intent where we have signed, we have another 20,000 seats. So total about 150,000 seats, is what we have on the table right now. We will continue with our guidance of 135,000 seats going live by March of 25.
Okay, so the operational portfolio is around 110,000 and you'll take it to 135,000 by March 2025. Just a word back on that pricing escalation. You said 5% is what happens usually, but it has been higher. How much higher this time around, Amit? And is this something which will continue? Is it is it low double digits? Is it high single digits? Wanted a sense on that.
So the range will continue to be between, I would say, 5 to 7%. Typically, we build escalations into our contracts of about 5% year on year. I think right now what we are seeing is a bit of an anomaly, but it will continue to be in the range of 5 to 7% going forward.
Okay. So, you had guided for around 150 basis points of margin improvement in FY25, which has already happened. Do you want to scale it higher? Also, in terms of revenues, you had said 30% growth is possible. Half year down the half mark in the half-yearly number, you've already seen 40% growth. Do you want to scale that upwards as well?
So I think the guidance for H2, I think, will be better than H1 is all I can say. I would not want to quote any specific numbers, but clearly I think we have seen improvement both in the revenue projections as well as in our margin projections. I think H2 will be better than H1. I'll leave it at that.
Okay, but you do not want to scale your guidance higher despite all the positives that you're seeing in the business.
No, so I think automatically with my comment of H2 being better than H1, I think we are, committing that, the guidance is going to be higher.
Okay, so there will be some revision, but you're not giving us the exact number right now. You said 135,000 operational seats by the end of this fiscal. What is the capex planned here? How much will be there in tier 1 cities? How much in metros? And also in terms of managed aggregation versus the other segment, how much will come in from this managed aggregation portfolio?
So in terms of managed aggregation, we currently sit at about 67% of our portfolio when it comes to seat is in managed aggregation, 64% when it comes to the number of centers. So the guidance is 65% managed aggregation, 35% straight lease, and that guidance continues, and we will continue to grow in that regard. Today, in terms of our tier 1 and tier 2 city portfolio, of the total seats of roughly 130,000, which is the seats that are operational and plus the 20,000 seats that are under fit out, about roughly 120,000 seats are in tier 1 cities and about 10,000 odd seats are in tier 2 cities. Our guidance going forward is that currently we are a 90-10 split between tier 1 and tier 2. This will continue to be about 85-15 as we continue to add more into the tier 2 network. We just added Guwahati in this quarter. So we currently are in 8 tier 2 cities and 9 tier 1 cities today. We look forward to adding 1 or 2 more tier 2 cities in the next couple of quarters.
Okay, all right. Take that point. Thank you so much, Amit, for joining in today and giving us all those details. So definitely a strong quarter, but the stock is seeing some profit booking today and the market's in that mood as well. That's the word coming in from Office Space Solutions, looking at strong growth going forward. But on that note, we'll wrap on this edition of Trading Hour. Stay tuned. Halftime Report is up next with all the market action.